Everyone, and welcome to part 2 of our webinar, Foraging Through Forgiveness, Maximizing Your SBA Grant. And I can see from the questions that are already being submitted that quite a number of our listeners and attendees today were with us last Thursday for part 1 of the webinar, when we began to talk about what was then bill that Congress had passed and the impact it was going to have on forgiveness. A lot has happened since then, and I want to welcome back those who were with us last Thursday, as well as the new faces and names, or more names than faces, I suppose, that are with us now. Couple of administrative points before we jump in. Number one, today's 1-hour webinar is being recorded. The recording will be available on the Viventium section of our website called Webinars. I'm Yonina Shineweather, CPA, the Consulting Director of Compliance at Viventium. We're going to be getting very hands-on today. As I had told you on Thursday, basically taking a fine-tooth comb to the form and literally just plowing our way, foraging our way through that form and how to fill it out. And along the way, we're going to be discussing the developments that happened since last Thursday. First of all, we're going to recap the new law, which when we spoke was just a bill. It's now been given a name called the PPPFA, the Paycheck Protection Program Flexibility Act. And that was actually signed into law by the president on Friday, June 5th. And then yesterday, June 8th, the SBA, together with the Department of Treasury, announced additional information about the PPPFA that answered some of our questions, addressed some of our concerns. Was basically very good news, and we're going to discuss that. Then there's a special bonus that we had promised as a kind of a sneak preview, which is a 1-page safe harbor summary that I'd like to go through with you. There's 5 different safe harbors, and I've seen some of the questions that are already pouring in address, well, what if we can't open yet? What if our business is closed because of regulation? And where does that put us in terms of getting our forgiveness slashed? So we're going to be discussing those safe harbors and especially how they've been expanded recently. Then we're going to take a very colorful journey through the form, literally line by line. And you might say, well, I think the form is going to be changing because of the new PPPFA. Well, I'll talk about that and why the old form is still important and still significant. I'm also going to do with you a filled in version of the form. Not filled in with numbers, obviously, but filled in with words that you can basically print out, because you'll be getting a copy of these slides, and keep side by side with you as you fill out your form, because it's a line by line commentary, if you will, on the form itself that you can use. Now, some of you were submitting questions along the way about the mathematics. So this 75%, this dividing by 0.75, aren't we supposed to be multiplying by 75? Can you please give numbers? Can you show how it works? So we're going to work some numbers there and end up with a forecast for forgiveness. And time permitting, we'll work in some more of your questions and answers. So that's basically the agenda of what we're going to do today. I want to remind you, those of you who have just joined and hear me at the beginning, please do use your question toolbar. Those of you who saw when whoever was here early, I was already answering the questions at the beginning, writing your answers back. There's been quite a number of questions submitted, and please do keep taking advantage of it, because as much as possible, I do keep my eye on your questions and try to work them into the presentation. And if there's something that I'm saying that you feel you want further explanation of, then probably other people do too. So you'll be doing everyone a favor by typing it into your question bar. Okay, and with no further ado, let's do a quick recap of what was called HR 7010. It now has a more official name, the PPPFA, and as we mentioned, it was signed into law on Friday as expected. So first of all, it tells us that any amount that doesn't get forgiven for whatever reason, for any loans that happen after the law was signed, you're going to have 5 years to pay them back instead of 2 years. Well, where does that leave all of you who took out your loans, mostly who took your loans before June 5th, and you're still stuck with a 2-year repayment? So you can go back to your lender, and hopefully you'll be able to renegotiate the terms to bring them into parity. We're also hopeful that in its promised guidance, SBA will instruct lenders to be flexible with those who have already, gotten their loan. Why should they be penalized? And if the intention is to expand flexibility, as its name purports, then it would seem to behoove lenders to renegotiate those terms, but that's again something to take up with your bank or your authorized lender. The main purpose of PPPFA was to greatly increase the likelihood of you getting all of your loan forgiven. So first of all, before this, you only had 8 weeks to spend your loan amounts, which for some of you was just not enough due to, you were basically saying, well, do we have to be we're becoming the new unemployment agency. In other words, our employees are staying home, they can't come to work, or at least a good portion of our workforce can come to work. And if we want forgiveness, we have to pay them anyway. So Congress came through and said, well, of course we want, employees to have their money, but we also want industry to be able to function. And therefore, we're letting you spend these funds for up to 24 weeks or until December 31st, if that comes first. And hopefully within those 24 weeks, America will return to full business and you'll be able to actually use the money to pay employees for work that they're doing. And for those of you who are all ready to go, as we mentioned last time, and you want to use the 8-week rule, you want to just send in that application now, then by all means you may. If your loan was before the law, before June 5th, then you can still opt for the 8-week rule. And that's one of the reasons that I'm going to be focusing so much on the form now, because those of you who said, look, I used up my funds already, I'm done, I want it off, I want to have this whole thing taken care of, I don't want it hanging over me, and who knows, will funds run out again? I mean, no one's saying that. Congress, there's still $100 billion of unclaimed funds that weren't even taken as loans, so we're not really, nervous about funds running out. But still, if you just want to know that forgiveness is done and it's behind you, there's no reason to wait, then by all means use that form, and we will go through it today. And I'll discuss another reason why I think it's important to go through the form as it exists right now. The second point is we are assuming, although we're still pending SBA loans, that just like before, the cap for employee compensation, cash compensation, was 8 weeks out of a year of $100,000. So we're assuming that will now be updated to 24 weeks out of 52. In other words, if it's based on an annual $100,000, the amount should go from $15,385, which was 852s of 100,000, to 46,154, which is 24 seconds of that 100,000. And presumably the owner partner cap, which was a dual cap, both 15,385 and 850 seconds of their 2019 compensation. Presumably that 850 seconds will also be raised to 24. Now, I know I'm going through this really quickly. If any of this is confusing to anyone who wasn't on our first webinar, please do go to Viventium.com, to our webinar site, and listen to the first webinar, just so that you're able to be on the same page as everybody else. Point number 3, this was a biggie. Previously, before PPPFA, you could only spend 25% on other types of qualified costs, which is mortgage interest, rent, and utilities. You could not spend any more than that, otherwise you would not get it forgiven. Well, they've expanded flexibility, Congress has acted, and now you can spend up to 40% on those other 3. What we were hoping Congress might do was say you can also spend on other types of expenses besides interest, rent, and utilities. That far, Congress did not go in terms of extending flexibility. It's still those same 3, but you can now spend up to 40% of it. And you only have to do 60% of payroll. Now, people ask me, can I do more than 60% of payroll? By all means. You can do 100% of payroll. You don't have to claim forgiveness for any of your interest, rent, utilities. That's optional, but the flexibility is there. And what we were afraid of on Thursday was that the law had been written, and if you take a look at it, it's still written that way. It says to receive loan forgiveness, a recipient shall use, emphasis added, shall use at least 60% of the loan, which made it sound like if you didn't use 60%, if you only used 55 or 40% of it for payroll, that's it, no forgiveness at all, zero forgiveness. That was the language of the loan. However, the announcement of yesterday, as I said, it's more good news. The SBA and the Department of Treasury teamed up together and they announced that, no, that's not what they're going to be doing. Even though that's what the law says, that's not how they will be applying the law. So despite the law's language, partial forgiveness will still be available, just as it is now. The rule now is 75% of payroll, but if you did less, you could still get partial forgiveness. So partial forgiveness will still be available, even if you use less than 60% on payroll, and we will work through those numbers when we do the mathematics of forgiveness. So that was very good news. That cliff, or that deep pit, as we called it, has been filled up. We're not afraid of that anymore. More good news, and that was you had been given just till June 30th to restore decreases in headcount or decreases in pay that were happening between February 15th and April 26th. Well, that's been extended now, which is great, till December 31st. That's good news. And a safe harbor, another safe harbor. There were 4, now there's 5. Well, actually, this is just an expansion of one of the existing 5, but we'll see that soon on the chart. But one of the 5 safe harbors was greatly expanded. And it says that, and this is a question that someone asked me, what if I'm in an industry that just can't open up? Well, if you can't open because of a regulation that was issued by either OSHA or CDC, or Health and Human Services, if any of those 3 government agencies, the Center for Disease Control, OSHA, or the or Health and Human Services, any of those COVID-related requirements from March 1 and on, previously we had said March 21, there was some confusion about the date. The correct date is March 1 through the end of the year. And therefore you can't return to your pre-February 15th level of business, of course, keep documentation, then you won't be penalized. Your forgiveness will not be slashed if you can't get your employee headcount back up to what it was. And similarly, if you can't rehire those same employees for whatever reason, and you also can't rehire similarly qualified employees, then you won't be penalized if you can't get your FTEs back up to its pre-February 15th level. So that's more good news. And finally, those of you who have been deferring employer Social Security tax and you knew that you would have to stop once you got your forgiveness, can again breathe a sigh of expanded relief and say no, because Congress has said you can keep on deferring employer Social Security tax whether or not your loan has been forgiven. Those of you who are with Viventium will be seeing an update to your consent, to your request, where you request to have that. There was language there that said that, I recognize that once my loan is forgiven, I have to stop deferring. That will be stricken from your agreement, and you'll be able to keep on deferring as long as you would like through the end of the year. So let's take a look now at the announcement of yesterday. First of all, you have a link to it here. And again, for those who are asking, these slides will be made available to you at the end of after the webinar, and the recording will as well. So here's the link to the press release. And here's what they say about that deep pit. And the language here is a little confusing, but let's parse it together. If a borrower uses less than 60% of their loan for payroll during the forgiveness covered period, you, the borrower, will continue to be eligible for partial loan forgiveness subject to at least 60% of the loan amount having been used for payroll, meaning whatever amount you use for payroll, you gross up to see what the full amount will be that will cause 60% of the full amount to be payroll. Kind of like a gross up calculation. I'm going to do numbers with you. It's just too hard to say in words. So just wanted to tell you the words that it says there in the release. Furthermore, another benefit here, there had been previously a provision that any non-forgiven principal or any interest or any fees that were due on your loan had to be repaid within 6 months. Now, that was kind of problematic because what if you didn't get a forgiveness decision within 6 months? Well, are you going to know how much to? So what they've said is now they've actually linked the repayment to the forgiveness. And they've said that no principal, interest, or fees will be due until SBA gives your bank back the money that they're forgiving to you. So now let's say you took a loan of $150,000. And let's say you're asking for forgiveness on $100,000 of it. So that means you're gonna have to repay $50,000. So until SBA gives that $100,000 to your bank, because they're forgiving it to you, so they're gonna give it to the bank, until then, nothing of the $50,000 will be due for you to have to pay to your bank. That's a relief. What if somebody never applies for forgiveness? Well, then you get 10 months after the end of the covered period, that 24-week period. Okay, that's just an important provision. Or the 8-week period if you're still before the law. Or if you're choosing, I shouldn't say that, if you're choosing to take advantage of the 8-week period, then that would be the end of your covered period. You have 10 months from then. But again, if you're choosing the 8-week period, then you're applying for forgiveness. So it's kind of a catch-22. If somebody doesn't send in any application at all, then they will be deemed to have to be repaying everything 10 months after the end of their 24 weeks. But for those of you, most of us will be sending in the forgiveness applications. You won't have to pay anything back, if there is anything left to pay back, until SBA reimburses the bank. And the last piece of good news in this announcement was that SBA says they will promptly issue, that's a quote, rules and guidance and two modified applications, a modified loan application and a modified forgiveness application. Now, I'm not sure why they need to issue a modified loan application for those small employers who want to still take out loans, because nothing should have really changed in the loan application, but it looks like they are anticipating changes there. So we're gonna have to keep our eyes on that. If anybody has division or anybody hasn't applied for their loan yet, to see what's going to be modified in the loan application. That's kind of interesting. Of course, the modified forgiveness application, we understand why, because there's just been so many changes to the loan application, to the forgiveness application. And here is what I think is probably one of the most important slides here, because there are 5 safe harbors that you can take advantage of to maximize your grant, to maximize your forgiveness. There's no nice list of them in the 11-page packet that contains the 3 pages of forms for forgiveness and the 8 pages of instructions. You kind of have to comb through them. Some of these safe harbors are in the instructions, some of them are on the face of the form, some of them are buried in the whole process. So what we've done for you here is spell them out for you. 2 safe harbors that apply to pay reductions, 2 safe harbors that apply to headcount reductions, and then the one last safe harbor that applies to both. So let's take a look at them. First safe harbor, and this is you're getting really the first preview of this. The first safe harbor is called "The reduction was not more than 25%." Not a very elegant name, but I think it says it all. So that means that if you reduced employees' pay, salary for salaried employees, hourly wage for hourly employees, but if you reduced it no more than 25% of what it was during the look-back period, and as we said last time, look-back period is January 1 through March 31. We have no reason to think that will be changing on the new forgiveness form. We could always be surprised, but Congress didn't say anything about changing it, so we're gonna, and I don't think that was the intent of Congress, so I do not think SBA will be changing that look-back period. If you did not reduce any one employee, this is not talking about your whole company. It's not done on a company level. You have to look employee by employee. That's an important point there. But if no one employee's pay was reduced by more than 25% during the covered period, which will now be the 24-week period, then even if it went down a little bit, you won't be penalized. Your forgiveness will not be slashed by the amount of pay decrease. That's a safe harbor. Second safe harbor for salary cuts. That is any employee who earned more than $100,000 in 2019, or the annualized equivalent in 2019, they will not have any effect on your forgiveness, even if their pay is reduced by more than 25%. So again, you had someone earning, let's say, $200,000, just for the sake of the ease of the numbers, in 2019, and $100,000 in 2020, or at least during the covered period, the equivalent of $100,000. So their pay went down by 50%. Does that mean that the reduction of their pay is going to reduce your forgiveness dollar for dollar? No, because they were highly compensated in 2019. They were a $200,000 earner, and the law was not designed to protect them, and so therefore you will not lose out by cutting their pay. So again, this can enter into staffing decisions, salary decisions when deciding, and especially, we'll talk about this in pointers later, but if you do need to cut salaries or wages, first of all, you have to keep your eye on not doing it in a discriminatory way, and second of all, you may want to keep everybody just within that 25 border, and that way you can still cut costs without losing out on forgiveness. That's an important employee by employee metric to keep your eye on. Now let's talk about headcount. What if you have to reduce your number of employees or the number of hours they work? Well, if you had no reduction at all this year, meaning you didn't reduce your employee or your paid hour count from January 1 till the end of your covered period, then that's okay. Then even if your FTE ratio is going to be lower than last year or in your look back period, in other words, somehow it's lower, but the reduction didn't happen now. It didn't happen from January 1 going forward. Maybe there was a reduction at the end of December last year, right? So it was still, when you're going to see that reduction in the ratio, when you're going to look at your ratio, your covered period is still going to be lower than your look back period. Let's say you were using a look back period from 2019 perhaps. But as long as there was no reduction from January 1 and on in either employee count or paid hour count, then your FTE count will not be slashed. no reduction there. There's also something called a reduction exemption, which, as we mentioned last time, is a good thing. Kind of hard, it's like a double negative. A reduction is a bad thing, and a reduction exemption is a good thing. And that states that if for some reason your FTE was reduced because of extenuating qualified circumstances, then you will not be penalized. So we knew up until now, up until the PPPFA, those extenuating circumstances were A, the employee voluntarily quit, B, the employee was fired for cause, C, you laid off the employee, but then you offered them in writing to come back to work at the same terms and they rejected the offer, and you reported it to the state unemployment office. And D, the employee voluntarily requested an hour reduction. Those were the reasons that were allowed before to be called reduction exemptions. Now we've added the two that we saw before, that if you for some reason could not return to your pre-COVID, your pre-February 15th level of business due to government regulations issued from March 1st and on, then you will not be penalized for FTE reductions. Or if you're unable to rehire the employee, that term unable has not been expanded yet. We're hoping to get more expansion in the SBA rules and guidance. But if you were unable to rehire the employee and you were also unable to hire a similarly qualified employee, then you will also not be penalized. So that's your reduction exemptions. We'll see soon where that comes in on the form in the second part of our webinar. And the last one, which applies to both pay cuts and headcount cuts, if you reduced your pay or your headcount between February 15th and April 26th, and you restored it by what was June 30, and now PPFA has made that December 31st, then you will not be penalized for those reductions. So that's good news. Those are your safe harbors. And now we're ready to start taking a look at the form itself. So the form is basically made up of three parts, and we started this last time. Now we're going to go into it in depth. The first page, we'll call it the main form. They call it the calculation form. That's where you start with just your name and numbers and everything. You get down to the bottom of the amount that you're asking for. That's the main form. The main form is supported by something called Schedule A, which gives some detail of what's on the main form, and it flows into it. And Schedule A, in turn, is supported by a worksheet to Schedule A, which is actually a listing by employee. You're going to have to attach, if you have more than 5 or 6 employees, you're going to have to attach an additional report, which you'll get. Those of you who are Viventium-ites will be getting from Viventium, of course. As we mentioned last time, best practice, don't wait until your 24 weeks is over. Turn to your payroll provider, check out your software. If you're using in-house software, off-the-shelf software, make sure you can extract the data for the Schedule A worksheet and that you're good to go when it comes time to apply for forgiveness. So now let's take a look. We said last time all the introductions, the SBA and the PPP numbers. Your lender number may have a different one than the government. Put the numbers here. Put your loan amount, because that's going to be the maximum, obviously, that can be forgiven. Your loan disbursement date is the signal for the beginning of your covered period. The covered period runs 8 weeks after the loan disbursement date. In other words, the loan disbursement date plus 55 days. It's a 56-day period. Now, even though you're saying, well, isn't this application going to change? It will change, but it won't change, meaning instead of the instructions saying take 56 days or 8 weeks, it's going to say take 24 weeks. But the structure, the way the form is built and the way information flows together, that's going to stay the same. Just the additional flexibility is going to be built in. In other words, instead of 15,385, it'll say 46,000, whatever that number is. That's all. But we still need to focus very intently on this form because this is going to be the structure. This is the way the form is going to work. Okay, so they ask these two presumably meaningless questions. How many employees did you have when you applied for the loan? How many employees do you have now when you're applying for forgiveness? This is not an FTE number. This has nothing to do with forgiveness. We don't know why they're asking it. Your economic injury disaster loan amount, if you had any, and your payroll frequency. Okay, now we get into the covered period. So it starts from your first installment, as we said last time. If you had a few installments, you counted from your first installment, and you count 8 weeks forward if you're doing it, if you're opting for the 8-week option. Those who get loans now after the law can't take the 8-week option. They must only take the 24-week option. and you run it through till the end of the 24 weeks. Now I had someone ask, can I do it before 24 weeks? Can we send this in before our period has ended? Let's say we've used up all our funds, we want to apply for forgiveness. Presumably the answer is yes, but there's no guidance about it yet. In other words, we're waiting for SBA, because there will be some of you who want to make sure that you send in your forgiveness as soon as you've used up your funds. If you spent everything on at least 60% payroll, then why wait? So presumably you'll be able to, but again, we're still awaiting guidance with the new form. So the covered period will run for 24 weeks, starting from the disbursement date. The alternative payroll covered period, they've tried to bring it in sync with payroll cycles. So they've said if you don't want to use the arbitrary date or the non-payroll related date of your loan disbursement, you can use the first payroll begin date after your loan disbursement. And we saw last time on the calendar how the overlaps could be slightly different, but the principle is the same. The idea is the same for these 24 or these 8 weeks. That's the $2 million, again, as we mentioned last time, that just means that they're going to assume your certification is made in good faith. They're not going to investigate your certification. It does not mean that they won't examine your application or choose to audit it. Okay, let's get started with numbers. So the first thing we start from is, what is your payroll cost? And that comes from here. Where the arrow is, that's coming from payroll costs on Schedule A. Well, what is payroll costs on Schedule A? It's made up of a few different pieces. And they're light pink. First of all, it's the cash compensation that's flowing in from the worksheet per employee. When they say cash compensation, it doesn't mean it has to be paid in cash. It can be paid in check or debit card or credit. It just means that it's your actual money that you're paying them, as opposed to fringe benefits like contributions to retirement plans on the part of an employer, as opposed to employer contributions toward health insurance. And the reason we're breaking those two things out separately, you get to count your employer contributions to health insurance. You do get to count your employer contributions to pension plans. The reason it's broken out is because the cash compensation is capped at that 8-week or 24-week limit, the $46,000, the $15,000. It's capped there. The benefit's not. So if you make large contributions to employees for their health insurance or for their pension plans, you don't have to cap that at the $15,000 or the $46,000. That's why the amounts are broken out separately. So this is just cash compensation. Then you're supposed to add in another line of cash compensation. What's the difference? What's Table 1 and Table 2? We'll see that soon. Table 1 is employees who earn $100,000 or less during 2019. Table 2 is employees who earned more than $100,000 during 2019. Now you might wonder, why are they breaking it out? Well, anyone who was paying attention now, you know already why they're breaking it out. Because the amounts in Table 1 are subject to reduction for salary. If you slash people's salary more than 25% and they're, so to speak, low earners, less than 100,000, you're going to suffer because of it. Your forgiveness will be slashed. However, those in Table 2 exempt you from forgiveness reduction if you reduce them, because they're high earners. That's the reason. I understand there's 2 lines here for cash compensation. Then you're asked to add in any contributions you, the borrower, made to employees' health insurance. That's great. That's not capped. Any contributions you make to their retirement plans, 401k, 403b, 457, anything qualified, and any taxes that you, the employer, pay on their salaries. So if those of you who are in states where there's occupational privilege taxes or any employer taxes that are tied to payroll, and all of you are in states where there is state unemployment tax. So all those employer taxes get added in. Now, I do want to point out, didn't mention this last time, this is important. Sometimes you'll look back at your payroll records and you'll say, well, you know, my payroll company was taking out so much and so much each week. That's the amount I'm going to use for my unemployment tax. That does not usually work for first quarter amounts, because usually states don't issue your state unemployment rates until during first quarter. And you know how you always have this variance? Those of you who are with Viventium, you know, you'll get a variance from the tax and saying, well, your rate went up, we have to take more, your rate went down, we're giving you back, you know. So variances, those of you who are doing this on your own know that you may be paying into tax services, you know, throughout the quarter. There's always going to be that quarter end variance. You need to take that into account. If you paid more SUTA tax, wow, that's wonderful. You're going to want to be able to claim that towards your forgiveness. If you paid less, then you can't just take your weekly contributions to unemployment. You're going to have to reduce it by the amount of that your variance took your amounts that you were paid down. So that's an important point there. And then the last number that goes into payroll is owner/partner employees. If any of you have owners who work for the company or partners who work for the company. Now, you can't really know yet if you have owners who work for the company for one simple reason. SBA didn't yet define what an owner is. It's a 2% shareholder count. You know, it's joint ownership. We don't know what that means yet, but whatever it means, and again, they're going to promptly release, as they said, definitions of what it means. So whatever it means, you have to list their compensation separately. You can't be putting it in table 1 people. You can't be putting it in table 2 people. Owners and partners get counted separately because, as we said last time, they wear 2 caps, right? They're an employee and an owner. Well, they also are subject to 2 caps. You can't count more than the $15,000 or the $46,000 of their pay. And you also can't count more than you paid them, or at least the 8-week or 24-week equivalent of what you paid them in 2019. So that's a pretty hard hit for owners or partners. If somebody wasn't taking a salary in 2019, then even if they took a salary now, none of it can count toward forgiveness because it's based also on 2019. There was some murmuring about a lobby about that, but nothing has really gotten off the ground yet. So all of those numbers added up, the cash compensation for both kinds of employees, the employer contributions to pension, health insurance, employer taxes, and the owner partner amounts, they all get added up and they flow through to line 1 of your forgiveness application. Now lines 2, 3, and 4, I'm not going to say anything about because they're not payroll. Okay, it's your mortgage interest, your rent, lease payments, and utility. One thing I will say that you don't have to put anything here. It's optional. If you want to use 100% of your loan for payroll and just request forgiveness for all of that, you're perfectly welcome to. Why might you not want to claim utility, rent, or mortgage? Well, I'll just say this, as I mentioned last time quickly. Those of you who are CPAs and bookkeepers will understand this. The IRS disallows corporate deductions for any amounts that were forgiven. If you were forgiven for your mortgage interest, if you were forgiven for your rent or utilities, you will not be able to claim them on your 1120 or your corporate return that you'll be filing. And you may have reasons for preferring to be able to take those deductions. So you don't have to claim it here. Okay, let's continue on the form. So we looked at lines 2, 3, and 4. Now we're up to line 5. And this is new. We didn't do this last time. Line 5 says, tell the SBA how much, by how many dollars you reduced your salaries. Because you know what we're going to do? We're going to make you dollar for dollar reduce your forgiveness by this. Okay, so what does this mean, how much you reduced your salaries? Where does this come from? It comes from here, line 3 on the Schedule A. And basically that is flowing through from the worksheet, which we'll get to soon. And it says that if you reduced any one employee by more than 25%, put the amount here, unless safe harbors apply. For example, they earned more than $100,000 in 2019, then don't put that here because it's only table 1. Or unless their salary went down between February 15 and April 26, and you brought it back up by, used to say June 30, now it'll say December 31. That's another safe harbor. Don't put that amount here. But all other amounts put here and flow them through into line 3. Now, add up your payroll cost, your mortgage interest, your rent, your utility, and subtract dollar for dollar the amount entered in line 5. That's your reduction. That will give you a preliminary amount. That is a preliminary forgiveness amount before your headcount reduction. That's only after your pay reductions. Remember, there's 2 kinds of reductions, pay reduction and headcount reduction. We just did pay reduction. Now we're going to have to do headcount reduction. Headcount reduction is not dollar for dollar because it's not dollars, it's headcounts, it's hours, it's FTEs, it's number of full-time equivalents, employees and equivalent to full-time employees. So it can't be dollar for dollar. Instead, it's going to be a quotient, which is another word for a ratio or a fraction. We're going to put a fraction, we're going to put a decimal on this line, and that decimal is going to reduce your forgiveness. What decimal do we really want to see on this line? We want to see here 1.0. In other words, because we want to see that we're going to get 100%. Whatever amount you have on line 5, your preliminary, on line 6, your preliminary amount, it's going to get multiplied by line 7. And the modified total is going to go on line 8. So we're hoping that that line 7 is going to be as high as possible. Where does that line 7 come from? It comes from here. It comes from line 13 of your Schedule A, your FTE reduction quotient. Now, what is your FTE reduction quotient? How is it calculated? We did definitions in part 1. Those of you who would like to hear these terms explained, like a dictionary, you can listen to the recording. We did definitions, but here I'll show it to you in numbers. You take your total FTEs, which means your FTEs from table 1 and your FTEs from table 2, meaning all the people that worked for you, all the FTEs that you had during your covered period, averaging, of course. We're not comparing absolute numbers, as I explained last time. You can't compare 8 weeks to, to a whole look back period of that wouldn't be fair. It's averaged. Everything is averaged and equalized. But you take your average FTEs, and again, this is something that will happen automatically inside Viventium when you use the PPP tool. You're not going to have to worry about these calculations, but those of you who are doing this on your own, you want to make sure to read the instructions very, very carefully to learn how to do this averaging and annualizing and equalizing. They have somewhat complex calculations how to do that. We take care of that for, for our Viventium people. But what you want to be doing is you want to take your average FTEs during the covered period, during the 8 weeks / 24 weeks, and divide that by your FTEs during your look back period. Now you get to pick 3 different look back periods. We talked about this in the dictionary. But this is what you're doing. You're dividing your FTEs during your covered period, meaning when you're applying for forgiveness. Divide that by your FTEs during your look back period. Hopefully the number will be more than 1 if it increased, and then you just cap it at 1. You can't get forgiven for more than that. But if there's any reduction, so let's say I had 100 people, 100 FTEs during my covered period, and I had 200 FTEs during my look back period, so 100 divided by 200 is 0.5. That's the number that goes on line 13 and that flows through to line 7, 0.5. And then whatever number I have for forgiveness gets now multiplied. Let's move down to our next slide. The modified total is the multiplication of line 6 and line 7. So whatever nice forgiveness amount I had here is now getting slashed by whatever decimal, whatever reduction quotient I have on line 7. Okay, and then I have to see, well, okay, is that my final number, line 8? No. If it's bigger than my loan amount, which is up here, then obviously I can't get forgiven for more than my loan amount, so they make me bring the loan amount down here. Also, they also make me check, did I really spend 75% on payroll? So what do they tell you to do? They tell you to take your payroll cost and divide that payroll cost, or actually, I'm sorry, they make you take your loan amount, divide your loan amount. I get so tongue-tied with these, we're going to see it with numbers very soon. They make you take your loan amount, up here, same thing, divide that, and I'm saying divide purposely. I know some of you asked me, shouldn't it be multiplying? No, it won't be. I'll show you soon why. They make you divide that by 75, or it's now going to be divided by 60, 0.60, and put that number over here. Okay, so post PPFA, this number is going to be 0.60. And then these 3 numbers, purple, pink, and yellow, you take the smaller of them, and that's your bottom line. It's either going to be your total costs after slashing for pay decrease, after slashing for headcount decrease, or the amount of your loan, or can't be more than payroll constituting 75% of your loan amount. That's the amount that will be forgiven. Now, let's talk about this 75%. Why are we dividing? What's going on here? Let's look at some numbers. Here's the mathematics that I told you we were going to look at. Why in the world are we dividing by 0.75 or 0.60? Why aren't we multiplying? What are we doing here? So this is, for those of you who like to use the term for payroll, this is a gross up. So let's look at pre-PPFA and post-PPFA. The principle is the same. I'm just going to illustrate it with the different percentages. Let's say your loan was $500,000 and you spent $100,000 on payroll and $50,000 on interest, rent, and utilities. Okay, so your total spent was $150,000. You would like to get forgiven for $150,000. However, the application says, 1 second, take your loan amount and check how much of it is being used for payroll. So your maximum forgiveness is only going to be able to be 133,333. Why? Because if you take 133,333 times 75%, that is $100,000. Okay, so in other words, again, we want the total that is going to come out, the grossed up total, to match the payroll in such a way that the grossed up total that I'm asking for is going to result in 75% of it being the amount spent on payroll. It's easier when you look at the numbers. Let's take a look at how it will work with the 60%, same numbers. And here you can see that the good news that Congress is giving you. You took a $500,000 loan, used the same thing, $100,000 on payroll, $50,000 on non-payroll. So your total spend is $150,000. But now you get to take that $100,000 and divide it by 0.60, not by 0.75. So you can get forgiven for $166,666. Wow, isn't that amazing? No, but you can't, because they're not going to let you get forgiven for more than your actual loan amount. Well, actually, in this case, you could, because no, you can't. You can't get forgiven for more than you actually spent. Again, let's look back here. That would be the modified total, line 8. It's the lower of all those numbers. So if your modified total is 150,000, assuming you didn't have any reduction, slashing of anything, your modified total is only $150,000. That's the most you can get forgiven for. You can't get forgiven for the full 60% gross up, but at least you can get forgiven for your full amount. So same exact numbers, but now with the new law, you're actually going to get more of it forgiven, which is really the purpose of the law. Okay, let's now follow how the worksheet flows into Schedule A. So Schedule A, as we saw, started with this cash compensation from Table 1. Here's Table 1. Okay, so cash compensation, you're listing, and again, this is coming straight from your payroll. It should be coming straight from your payroll service. Viventium's providing all of this to our clients. It's a list employee by employee of the total cash compensation capped at the $15,000 or at the $46,000. That's your cash compensation on line 1 of Schedule A. Then you have to enter your average FTEs. Remember, we need to know what were your FTEs during your covered period. That's, again, going to be on an employee by employee basis. You can't take FTEs for the company as a whole. You have to add them up on an employee by employee basis, and that's going to flow through to Schedule A. And finally, there's the salary reduction. And that's going to come only for Table 1, only for those who earned $100,000 or less in 2019. And again, you're going to be looking at each employee, seeing if his pay went down by more than 25% compared to January 1 through March 31 of 2020. Of course, equalized, annualized, not absolute numbers, and also checking if that reduction was made up by June 30th or by December 31st. And if it was made up, you're not even putting it here on these lines. You're only putting here the amount that does not fall into a safe harbor, and you're carrying that through to line 3. When we take a look at the filled in form, you'll have further explanation. Then you go on down to line 4. Again, this seems like the same thing. It's just cash compensation, but this one is coming from the smaller chart. It's smaller because there's no salary reduction on it. These are for the people who earned more than $100,000 in 2019. And the same thing, we still need to know their FTEs. FTE reduction does apply even to high earners, even to people who earned $100,000 in 2019. That's an important distinction. The salary reduction will not apply to them, but if the FTEs went down, even for your high earners, you're still going to lose forgiveness because of that. Okay, and let's just take a look at some of this other stuff here. We said already these are your non-cash compensation, and it continues on further. What's here, these lines at the bottom of Schedule A, again, those of you with Viventium don't need to worry about the mechanics of what's happening here, but for those of you who do, this is where we figure out if your numbers went down between February 15th and April 26th, in other words, during the real intensity of COVID. And if you then restored those numbers by June 30, and this is something that's going to change on the new application because it's not going to say June 30 here, it's going to say December 31. So this will change, but this is where we figure out if you fall into the safe harbor. And if you do, then it tells you go ahead and put a 1.0 on line 13. See what it says here at the bottom? If the entry for step 4 is greater than or equal to step 2, Enter 1.0 on line 13. That's where that quotient is. That's the number we want. That's great. 1.0 is like getting 100. That means no reduction. So if you fall into the safe harbor, you will be able to put a 1.0 there. So this down here on the worksheet, this is where it happens. This is where you figure it out. Now we're going to take the same information, present it a little bit differently. I found in my years of teaching, I found that some people work best with colors and arrows, some people like words, some people like numbers. So I'm basically giving you the same information, but just presented with a filled in PDF. So I took here a fillable PDF that one bank lender was kind enough to post, just a fillable form. And instead of filling in numbers, I filled in words. And the quality is not always the greatest because of the PDF limitations, but we're going to run through it. And what I really recommend you do is when you get your slides, print this out, laminate it, hang it up on your wall, and use it when you're filling out your forgiveness application. Of course, again, I want to stress those of you who are with Viventium will just be able to take the numbers straight off the Viventium tool. You're still going to have to make some decisions. For example, do you want to use a covered period or an alternative covered period? Do you want to use the exact FTE method or the simplified FTE method, which we'll talk about? So it's not going to be decision free, but it'll be simplified. In any case, this is a good reference. So your lender number, as we said, may differ from your SBA number. Your PPP loan amount is the maximum that can be forgiven. You can't get greater forgiveness than that. And your loan disbursement, it's the date of your first installment. So if you had more than one installment, use the date of the first one. These numbers, we do not know why they're requesting, so I'm just writing there, it's unknown why requested. And your economic injury disaster loan will figure in. If you received one, you have to put it here on the form. Your frequency. What if you have, and this question has come up, what if you have a few payrolls and an executive payroll, administrative payroll, a manual worker payroll, and you pay them on different frequencies? Well, as I mentioned before, Viventium has submitted some questions to the SBA. This is one of them. We're hoping it'll be in the rules, but I guess what they're asking, if you were doing it today, my best guess would be use your largest or your most regular payroll, or perhaps your most frequent payroll. But again, that's not just an educated guess. We have to wait to see what SBA is going to say. Your cover period, you have a choice, and those of you who are with Viventium and using our tool, you'll be able to iterate. You'll be able to run the report this way and that way and see which one comes out better for you. Again, if you had a large payroll right before you got your loan, you might want to use the actual first one, the covered period, so that you'll be able to use any check dates within that period. You won't have to start from your first payroll pay period beginning after the loan. Okay? We talked about that last time in detail. You can listen to the recording for more details if you'd like to. But your covered period is running right now from the loan disbursement date till 56 days later. That date plus 55. Similarly, your first pay period, the alternative payroll, it would be from the first pay period beginning after disbursement till 8 weeks after that. So if your weekly payroll, it's going to cover 8 payrolls. If you're biweekly, it's going to cover 4 payrolls. Okay, now we get into the details. Payroll costs, that is going to be the capped amounts that are flowing through from the schedule. That's the actual payments made to employees. Then you have your mortgage interest rate utilities. And again, this is not going to be deductible. Whatever you claim here, it's not going to be deductible on your corporate return. So it's optional. These 3 lines are optional to fill out. You don't have to claim them if you don't want to. And then comes the salary reduction. Those are for those people who were reduced more than 25%. Actually, instead of straining, let's do this. For these people who were reduced more than 25% relative to the period of January 1 till March 31 of 2020. And then you're supposed to add up these amounts and subtract the amount on line 5. That gives you your preliminary eligible forgiveness amount before FTE reductions. Then you're going to put your reduction quotient, which is the ratio of your current FTEs to your lookback period FTEs. And you can pick from 1 of 2 or 3 lookback periods. And then you get down to a modified total, which is the eligible amount after reductions. And then you put down your PPP amount, you put down your loan amount divided by 60 or 75%. That gives you, that makes sure that your payroll is at least 60 or 75%. And that gives you your final forgiveness amount requested. Okay, that's page 1. Let's go down to page 2 of the form. Here's page 2. Just make it a bit bigger. Your cash compensation from table 1, that's your capped gross for your lower earners, those who earned 100 or less in 2019. Your average FTEs, again, that's going to be your FTE count for lower earners. Again, when we do FTEs, we use 40 hours a week. I can't stress that enough. For ACA, we're used to thinking about 30 hours. For SBA, we're used to thinking about 32.5 hours. When you figure out your full-time equivalents, again, this is built into the Viventium tool, you're going to be using 40 hours a week. Now, people have asked me, what if I did it differently on my loan application? What if, this is questions that were coming in, throughout the webinar, what if I use 30 because that was my understanding of what AC, well, it's not related. One thing has nothing to do with the other. For forgiveness, you must use 40. Doesn't matter what you did before, you got what you got, it's the amount that you have, but for forgiveness, you must use 40. However, you have two choices. If someone is 40 or more, they're counted as one FTE. But what if someone's less than 40 for a week? Well, if they're less than 40 for a week, then you can either use an exact FTE. So let's say they are 20 for the week, you can use 0.5. Or you can choose to use a simplified method, which means if they're less than 40, then just call them 0.5. What would be the difference in the significance here? Let's say you have a significant number of employees who are only working 10 hours a week during your coronavirus period, during your covered period, 10 hours a week. Well, that's 0.25 FTEs. Right? It's only a quarter of 40. If you use the exact method, your numbers are going to look really low. It's going to look like, your numbers are really, went down the 10 hours a week. If you use the simplified method, you're allowed to just call all those people 0.5, and that's fine. Now, of course, you're going to be applying the same standard to your lookback period, but you want to kind of iterate through the report again and see which way comes best for you, because depending on how many hours or what the majority of your staff was working during your lookback period, it could come out to your advantage one way or the other. And therefore, you want to make sure that your payroll provider, your software, your programmers, whoever's doing this for you, your accountants, are well aware of the implications. The Viventium will be taking into account both the exact calculation, where you take the exact decimal, and the simplified calculation, where you just take 0.5 for anyone less than 40, and we'll be using the number that comes out to the biggest forgiveness amount in our tool. So that goes here on line 3. Then we go on further, cash compensation. Now we're for the higher earners, those who were more than 100,000 in 2019, their capped amounts, capped at 15,000 or 46,000. And then your average FTEs for those people, because again, even though they're exempt from forgiveness slashing, you're exempt from forgiveness slashing due to their salary decreases, you are not exempt from forgiveness slashing due to their FTE decreases. So you do need to, I know I'm repeating myself a few times, but so make sure we're all clear on this. And then you come down to the other stuff, any employer amounts to retirement, health insurance. This is not employee amounts. You cannot use employee amounts for this. And actually, the employee amounts were already counted because they were in the gross when we did compensation. And there's no cap on these amounts. And finally, your unemployment taxes, not employee taxes. There's no cap, and not federal taxes. You can't count federal unemployment tax. No FUTA, only SUTA or other state and local taxes. And the employee, the owner employee, the partner employee, they're subject to 2 caps. They have to be broken out separately on this line, and that gives you your total payroll cost, which is the preliminary to be forgiven. And then we look back at the FTEs, and we say, take your FTEs during your look back period. And you have 2 choices. You can take February 15th till June 30th last year, or you can take the first 2 months of this year. And if you're seasonal, as we said last time, you can take any 12 consecutive weeks in 2019 between May 1st and September 15th. Those are your look back FTEs. Compare that to your FTEs during your covered period. Again, equalized, not absolute numbers, the equalized amounts, and the fraction of line 12 divided by line 11 will reduce your forgiveness. Okay, and now we're ready for the last page here. And this is the Schedule A worksheet. So the employee's name in Table 1, those are going to be all your employees who earned at least 100,000 in 2019, or they didn't work in 2019. Do not include owners or partners here. Do not include independent contractors, and do not include non-US residents. There's no forgiveness for amounts paid to non-US residents. Then their identification is going to be the last 4 digits of their social. Your cash compensation that you paid to them, that's the gross that you paid them, but capped at the 15 or the 46,000, depending on how you're filing this, except for FCRA paid leave. If you paid them any leave due to any FCRA mandated reason, you may not count that because you didn't really pay that. The government really paid it for you because of tax credits. And that total goes to Schedule A. That's in box 1. Then you have to put in the FTEs. Again, you have to use 40 hours a week, not 30. And the total FTEs are going to get compared to the FTEs during your look back period. And if it's less than 1.0, that ratio is going to reduce forgiveness. But you're allowed to add back, here's a safe harbor, like I said, they're scattered all over. You're allowed to add back your reduction exemptions, which means any hours that were reduced because of these extenuating circumstances, they were fired for cause, they terminated themselves, they asked for an hour reduction, you offered them to come back in writing and they said no and you reported it to the unemployment office, you couldn't return to operation because of government regulations from March 1st and on, you were unable to rehire them and you were also unable to rehire anyone similar. Any of those reasons, you take those hours that were reduced because of those reasons and you add them back. You put them here where it says FTE reduction exemptions, you add them back, and that's the amount that goes in box 2. So that's the safe harbor. And then your salary reduction. So you don't have to put anything here if the pay reduction was less than 25% for the employee compared to January 1 through 3/31. You also don't have to put anything here, even if it was more than 25%, but it happened between February 15 and April 26, and it was restored by June 30/December 31. You also don't put anything here. Any amounts that don't fall into those, and the person obviously earned less than 100,000 if they're in this chart, have to go here, and that will flow through as a reduction to Schedule A. And then we do a similar thing in Table 2 for the employees who earn more. And again, here there's no salary reduction because there's no reduction in forgiveness. So this is, in words, what we just saw in colors and numbers. Some factors to remember. As I mentioned, do not count your non-US employee residents in cash compensation. As I mentioned before, a tip, if you're a weekly or bi-weekly and you choose to use the alternative period, because only weekly and bi-weekly can choose to use the alternative, and you had a higher payroll before your disbursement date, before you got your loan, you will be able to maximize more, get a bigger grant if you use covered period as opposed to alternative, because you'll be able to include that big period at the beginning. To avoid forgiveness reduction, you can't just offer a rehire you can't just offer a laid off employee a rehire. The original regulation, the original rules had said it was enough to offer, but SBA clarified that the offer must be in writing and the refusal must be reported to the state unemployment office. Document, document, document. Just keep everything documented. If you do have to reduce pay, as I mentioned before, try to keep it to less than 25% to employee. What 25% relative to the look back period, which is January 1 till March 31. If you forget what it is, you can always look in the dictionary that we did on our part 1 of the webinar. Again, as I mentioned, if most of your part-time employees work less than 28 hours during the covered period, using the simplified calculation where you can just call them all 0.5ers, 0.5, 0.5, 0.5, that may maximize forgiveness. And since you have a choice about your FTE look back, right, as we said, it could be January and February of 2020. It could be, if you're seasonal, any 12 consecutive weeks between May 1st and September 15th of 2019, and you also have a covered period from 2019. Choose the one that gives you the least FTEs. Viventium will do this automatically for our clients, but if you're doing this on your own, always do the one where your look back period has the lowest number, because that means you need to just live up to the lowest number possible. Here's just a forecast. Again, the Monday announcement, the June 8th announcement was the rules are coming, hang in there. We have been seeing lobbying of financial institutions where they just want to get SBA to forgive all loans under $150,000 just because of the bookkeeping nightmare involved. Best practices, maintain documentation about everything, about your expenses, about your payroll, about why you dismissed employees, why your level of, why you laid off anybody, did you offer them to come back? What is it about your business that can't return to normal? You have a board meeting, keep minutes why you're not able to return to normal, which government regulation, what's the name of the regulation that's preventing you from doing so. Keep everything documented. Those of you who have not yet gotten your loans, there's still over $100 billion available in PPP funds, and keep on turning to compliance, to industry thought leaders for updates. Be ready to turn on a dime, be ready to be agile around the requirements. a sneak preview of 2 great infographics that are going to be updated for the PPP-FA, as well as the new announcements, is Viventium's Division of Responsibilities. Those of you who are with Viventium, and those of you who are not with Viventium, wherever it says Viventium report output, just put there, you know, my provider is supposed to give me. This is just a division of where to find each piece of the form. And this great journey to PPP forgiveness, which gives you milestones along the way, what you need to be giving us at Viventium, or what you need to be giving whoever your CP, whoever's doing this for you. The decisions that you're going to have to make, as I mentioned, there's a few different iterations to run through and to see which one comes up better. And of course, the output that Viventium is going to give you and some common pitfalls to avoid. I've endeavored as much as possible to include questions that were asked throughout my presentation. We're pretty much at the end, but I do want to address a couple additional questions. What can be included in payroll costs? We know that severance pay can be included. Hazard pay, when you're paying premiums to employees for coming back to work at this difficult time, can be included. Parsonage amounts, parsonage allowances can be included. Bonuses during the covered period presumably can be included, again, if they're reasonable and tied to the hazard thing. If you know, the idea that you're paying employees for their extra work, or you're staying within your employee handbook guidelines for bonuses. If you're suddenly going to issue a huge bonus that seems to be just trying to use up funds, you know, for the 100% shareholder or something, I think that may be called into question. So you have to be reasonable about it. Some additional questions that were asked here. The cash compensation amount, should that be the total paid for the 8-week period? And the answer is yes, the total paid by employee for the 8-week period, but capped at a maximum of $15,385 per employee. We have to be careful about that because we're only allowed to take up to $100,000 for the year for an employee. And if you do 850 seconds of it, that gives you a cap of $15,385. That will presumably be adjusted to $46,000 some to allow for the 24 weeks. Again, copies of the recording, someone asked about a copy of the video. The recording of the webinar and the slides will be distributed to you together with some of the great infographics that Viventium has to offer. And we'll just take 2 more questions because we are running over time, but I know some of you are still hanging in there to get the answers to your question. The question is, what if we received our loan on May 8th and our pay date was May 8th? Can we use that payroll as part of the loan? So that would depend on which method you're going to be using. If you're using the covered period, where you start from your loan disbursement date, then any check date during that date, which would include the date of the loan, because that's one of your 56 days, can be counted. However, if you're using the alternative payroll method, where you're going to start from the first period begin after your disbursement date, then presumably your period begin is probably not the same as your check date, and therefore you would not use that. You would only use from your first payroll begin and the next 8 payrolls after that. And just a final question. How do I handle commissioned salespeople who cannot meet their sales from 2019? So again, here, this would fall into, presumably would fall into one of the new PPP-FAs at the end of the day. Okay, one of the new PPP-FA safe harbors. If your business is not returning to its normal levels due to government restrictions, let's say travel is restricted, let's say personal contact is restricted, and social distancing is restricted, and therefore your salespeople, which is part of your business, can't get up to their regular levels, then if they're not working as much, again, that would be the FTE point about it, you would not be penalized for that. Presumably, you could document all of that, and you could show that the reason they're not reaching their work level is because they just can't work. They can't go out and close sales. So that would be, in terms of dealing with the reduction in their FTEs. All right, I want to thank you all very much for participating today. Hang in there. You will be getting a copy of the recording and the slides and the infographics. It's been a pleasure holding both of these, part 1 and part 2. And again, the recording will be made available to you. And thank you very much for your time. Have a great afternoon, and hoping that everyone is able to obtain the maximum forgiveness.